Okay, so have you ever heard of a tax rule that sounds, well, almost too good to be true? Today, we are pulling back the curtain on one of the best-kept secrets in the entire U.S. tax code. It's a hidden perk that could literally turn your home into a source of tax-free cash. So how on earth does this work? I want you to picture this. There's a huge event in your town, a music festival, a major conference, you name it. You rent out your place for a few days, make a nice chunk of change, and then you get to keep all of it. Not one single dollar goes to the IRS. I know, it sounds like a fantasy, but it is a very real provision. Let's look at what that means for your tax bill. Yep, zero. Zilch. Not a dime. When you do this right, the tax you owe on that rental income is exactly $0. And look, this isn't some shady loophole, it's a legitimate rule, written right into the law that smart homeowners have been using for decades. So what is this incredible rule called? Well, the official IRS name is super boring, Section 280AG, the Minimal Rental Use Provision. But pretty much everyone calls it the Augusta Rule. And it got that nickname because of the Masters golf tournament in Augusta, Georgia, where for years, locals would rent their homes to golf fans and, thanks to this rule, keep every penny completely tax-free. The whole idea is beautifully simple. If you rent your home for 2 weeks or less during the year, that income is all yours. You don't even have to mention it on your tax return. As far as the IRS is concerned, that money just doesn't exist. All right, if there's one number you take away from all of this, let it be this one, 14. This is the magic number. It is the absolute hard and fast limit for this tax-free benefit. Not 15, not about 2 weeks, 14 days. It is the key that unlocks this entire thing. And trust me, the IRS is incredibly strict about this. You rent for 14 days, you owe zero tax on that income. But if you go over by just 1 day, to day 15, the entire game changes. Suddenly, every single dollar of rental income, right from day 1, becomes fully taxable. So yeah, tracking your days is everything. Now, of course, with a tax perk this good, you know there's going to be some fine print. To use this the right way and stay on the IRS's good side, there are a few conditions you absolutely have to follow. So let's walk through them so you can get it right. It really all boils down to 3 main pillars. First, you have to charge a fair, reasonable rent. Second, you can't deduct any of your rental expenses. And third, the property has to actually be your personal residence. Let's break each of those down real quick. Okay, first up, fair market value. All this means is you can't just invent a crazy number. If a house like yours normally rents for $500 a night, you can't suddenly charge your own company, say, $5,000 a night. You need some proof. Pro tip, just go on Airbnb or VRBO, find similar homes in your area for the same dates, and take a screenshot. Keep that for your records. Done. Now, here's the trade-off. It's a pretty simple one, really. Since the IRS isn't getting a cut of your income, you can't ask them to help with your costs. So any money you spend on the rental, professional cleaning, some extra insurance, maybe a minor repair, that's all on you. You can't deduct it. And finally, the place has to actually qualify as your residence. The IRS has this specific test, but honestly, for most people, this is a non-issue. If you're using this for your main home, or even a vacation home that you use a lot, you're almost certainly going to meet this requirement without even thinking about it. Okay, so renting out your house for a local festival is cool. That's a great way to make some extra cash. But what if you could take this to a totally different level? For business owners, the Augusta Rule isn't just a perk, it is a strategic power move. Let's get into how you can use this for your own company. This is where the real magic happens. You can have your own business rent your home from you. When you do this right, your business gets to deduct the rent it pays as a totally legitimate business expense, which lowers its taxable income. And you, personally, you receive that rent money completely 100% tax-free. It is a true win-win situation. And the process is really straightforward. First, you need a legitimate business reason. Think a quarterly board meeting, a team retreat, an annual planning session. Then, your business formally rents your home for that event, paying a fair market rate. The business writes it off as an expense, and you pocket the cash tax-free. It's that simple. Now, just a heads up, this strategy works like a charm if your business is an S-Corp, a C-Corp, or a partnership. Why? Because there's a clear legal separation between you and the business. If you're a sole proprietor or a single-member LLC, it gets a little more complicated because the IRS basically sees you and your business as the same person. It's not impossible, but you'll definitely want to chat with a tax pro about it. So, we have covered a ton of ground here. To make sure you've got everything you need to actually put this into action, let's wrap it all up with a final, super clear checklist. Okay, here are the absolute must-dos. 1. Track your rental days like a hawk. Never, ever go over 14. 2. Research and document your fair market rent. 3. If you're renting to your business, document the business purpose. Keep minutes, have an agenda. 4. This income does not go on your personal tax return. And 5. Don't deduct any of those rental expenses. You follow these 5 steps, and you are golden.
And that, my friends, is the Augusta Rule. It's a fantastic, totally legal, and seriously underused tool for homeowners and an absolute game changer for business owners. So the only real question left is, how are you going to use your 14 tax-free days this year?